just dive right into we're going to dive right into the content if you don't mind. So as we talked about first, we're going to talk about leads, where to find leads. Now, mind you, we can only do so much in an hour worth of content. So we're going to go through some of this fairly quickly. If you do have questions, again, throw them in the chat or we'll have a live Q&A at the end and we'll try and get to as many of those questions as possible. All right, so here's our top kind of ways that we're finding leads right now in the commercial space. Derek, take it away for the first time.
Yeah, so as you know, commercial and residential real estate agents, they're constantly working with borrowers that are looking, to either purchase or refinance commercial property. So they're a good source to help you, with the, finding borrowers that are, ready to make the refinance or purchase. So
what's interesting about this, and we've experienced this with previous MLOs that we've helped, is that the second you advertise to this group of people that you are doing commercial loans, and frankly all of them, but this one in particular, you'll start getting calls and deals almost immediately because they are in the market every day talking to commercial real estate owners. And so they're going to be your biggest source. I mean, think about it as well. If you think about the largest commercial real estate investor owner in each of your markets, they're not going to own more than, call it 20, 30, even let's say it's even 50 deals, 50 properties, which is a lot for most markets. Every single commercial real estate broker, investment sales agent is going to have way more clients than just 50 or even 100. They typically need to have about 1,500 to 2,000 minimum clients or potential clients in order to make their business successful. And so that's number one.
Mm-hmm. Next are other MLOs. As you become more and more competent in the commercial loan brokering business, you're going to be reaching out to other LOs that have deals that they don't know what to do with. So they're going to be reaching out to you to help out their clients. So, business bankers. So if you walk into pretty much any bank branch, there's a business banker that typically they have their own office or they sit outside, where the tellers. They work with, business owners. They work with commercial investors that, they need, those folks need financing. And those borrowers, they go to these banks because they have a relationship with the banks. However, what we found with traditional banks is they have such a small box that deals fit in. And so there's a lot of deals that just don't fit into their box. And so these business bankers, they're always looking for other solutions for their clients because they want to keep the relationship, the banking relationship. However, they can't if they don't have a loan solution for their commercial loan. And so if you talk to them and you help them out by getting them or getting their clients into a commercial loan, it's kind of a win-win relationship, and they'll be sending you more and more deals.
I think the key there, though, if you do that, first of all, there's going to be like a main branch in most cities for each bank that is going to house actually more than one business banker. There should be multiple business bankers. But the key to the relationship there is they don't want to lose clients. And so they don't want to give a client over to Keith and have Keith, take the client forever and not send him back. So the key is to make sure that you make the business banker feel comfortable that you're going to send that client right back to the bank for any other deal moving forward, so they could be involved in that process and involved in depository relationships and such.
That's kind of the main thing right now with bankers is they want to keep the deposits. And you as a commercial broker, you don't care about the deposits because that's not part of the loan. So,
and along with business bankers, I mean, any commercial direct lender that you talk to has some sort of a small box. And if a loan doesn't fit in that box, they just decline the loan or just send them off. And so if you gain a relationship with any commercial lender, in your market, you can enact the same type of relationship. The next two I'm going to kind of group together: attorneys and CPAs. It's pretty simple. Attorneys, especially real estate attorneys, obviously have, and CPAs have a lot of commercial real estate investor clients. And it's not just commercial real estate investor clients, it's business clients as well that own their own building that they operate their business out of, whether it's a warehouse or an office building, or a retail strip center, something of that nature. And so if you gain good relationships with those individuals and keep a constant communication with them, that's a good source. In fact, I went to, we live here in Utah, we went to a Jazz game last week, and the Jazz game was hosted by a local CPA firm. And that local CPA firm does tax accounting for over 100 real estate investors in my market. And so, I mean, that was a gold mine. And along with, with them, a bunch of those investors were invited to that suite at the Jazz game as well. So I had direct communication with those people. So that's a huge one. Management companies, especially residential management companies, but even commercial. Obviously, they like commercial investment sales agents have the duty to know and have a relationship with every commercial owner in their market, so that they could get their business on to manage their properties. And so they're a phenomenal source of business as well. And not only just locally, a lot of them are regional or national. And so if you have a relationship with a local management company, either the owner or the regional manager, they'll be able to send you business throughout the entire region. And then finally, your database of clients.
Yeah. So, if you've been in the business for, long enough, you have a long list of clients that are business owners or they're real estate investors, and they're looking to either purchase their own business or building for their business, or they're a real estate investor who is maybe looking to make the next jump up from single family residential properties to a 5-plex to a 10-plex, 15-plex, which ends up being in the commercial loan realm.
I mean, you all fill out 1003s, I assume, and so you all know who owns a business and not. So you can literally go back to your own database and call those individuals, and not only ask them if they're looking to refinance or buy a building, but you could ask if they have anyone else that they could refer you to. Yeah. Again, the second you start advertising that you are in the commercial space, they will see you as commercial, as resources in the commercial lending area.
Yeah, and what I like to do, just to end with that, go out to lunch a couple times a week. Pick a commercial real estate agent and just introduce yourself, invite them out to lunch, and get to know them and how their business is doing. It's funny how once you meet one of them, you talk about their deal flow and how you can help them out. A lot of commercial real estate agents, they don't necessarily know what loan options are available, and so you can talk about different loan options, especially for their listings that they have in their current clients.
So and to reiterate too, this is really interesting, because you would think that your best lead source would be the clients directly, and that's not wrong. But as far as volume of potential business, all of these people in this group here, they're going to have more referrals for you than you could gather yourself through calling clients individually. So really, those are really the keys here, and that's kind of an endless supply of referrals. And there's many more, but those are the ones that we find are key, especially in this market right now. Okay, on to lenders. So we're going to go through these different types of lenders. These are the main groups of lenders. So banks, agency lenders, insurance companies, CMBS, and debt funds. These are the main source of lenders that we go to. Most of you are probably more familiar with your local, small banks or the large national or regional banks. Those really only account for, you'll see different news outlets saying different things, but honestly, they should only account for a small percentage, 20-25% of your business. And we'll show you why as we go through these lenders.
Yeah.
First.
So yeah, so banks. All right, so banks are a great option for borrowers that are looking for construction financing. If they need a bridge loan, if the property is not ready, for a permanent loan, and then of course, permanent financing. Banks and credit unions are great for. They are recourse. For those that aren't familiar with recourse, if the deal goes south, it comes back onto the borrower personally, so they're personally guaranteeing the loan. They typically do smaller loans, anywhere from, I would say, 250,000 up to 5 million is typically where they max out at.
Kind of they get bigger, depends. So your Wells Fargo's and JP Morgan's of the world, they'll do hundreds of millions, but your most of your regional banks, stop at 5 and 15, 20 sometimes, just depending on the bank, but they're typically smaller checks than these other options that we're looking at.
They typically have 25 year amortizations. They may lower that depending on the property type. If it's a specialty property like a car wash or a gas station, they may go lower than a 25-year amortization. But overall, 25 years is pretty standard. And then their loan terms are 3, 5, 7, 10 years. And the borrower typically will pick how long of a term they're interested in, and the interest rates will typically be determined by how long the term is. So.
Those interest rates, just so you know, because we're not in here, but the interest rates are typically derived based off of the corresponding term swap rate. So if you look at Chatham Financial or MSNBC Financial or any Bloomberg, any of the financial websites that have interest rates, you'll look at the term swap rates. And so these banks usually have their interest rates are based off of the 3-year term swap rate or the 5-year term swap rate, 7 or 10 year, and then they add a spread over that rate. The really, really, really small banks actually go off of prime. And the second you hear they're pricing off of prime, that's a very high interest rate. You don't really want to go there if you don't have to.
Yeah. All right, next, agency. So agency is,
Fannie Freddie.
Yeah, so it's Fannie Freddie. So Fannie and Freddie, they have a separate division for multifamily loans. So larger apartment complexes, 5 units and above. They have small and large balance. Just a little bit of extra that they'll do assisted living, and they will also do mobile home parks. And so they're great options because they are non-recourse. So they won't come back onto the borrower if he defaults. He can just walk away from the deal if he wanted to. It won't even ding his credit. And their terms are, how I describe it to a lot of my clients is kind of like pick your own adventure. They have the standard 5, 7, or 10. However, if the client wants a 12-year or 12.5-year term, they'll make that happen. 15 years, and they'll go all the way up to a 30-year fixed term. And so it's a great option for those borrowers that like to just lock it in. Last year, I had an 89-year-old borrower who was looking to refinance his large apartment complex, and he wanted a 30-year fixed. And I said, why do you want a 30-year fixed? And he said, well, I'm not going to be around much longer. I'm going to be giving it to my kids, and I don't want them to screw it up. So he locked it in for 30 years, and it's a great property that cash flows really well for them. So, and then they have 30-year amortization. So, we find that if the property it's tight on loan dollars, going through the bank with a 25-year amortization, we can take it over to agency, run the numbers on a 30-year amortization, and we more than likely will get a higher loan amount for the borrower. So, and then the nice thing about agency is they have lower interest rates. So,
and they typically price off of the treasury. So if you follow the treasury markets that have been bouncing up and down recently, they price their interest rate on a treasury plus a spread. So it's typically the starting rate is the 10-year treasury plus 200 basis points or 2%. And then it could get better from there depending on all the metrics, the loan to value, the debt coverage ratio, affordability, and many other host of items there. Next, lenders. These lenders are very hard to reach because there's a lot of them, but very few employees of the insurance companies. But they are really meant for, they'll do construction, bridge, and permanent loans. Not all of them will do all three. Some of them will only do permanent loans. Some of them will only do bridge loans. And a lot of them won't even do construction, but a handful will do construction. And they're typically known for your trophy assets. So the biggest, nicest buildings in your market that are kind of new, very clean, good looking buildings. Those are the ones, great tenants, long-term tenants. Those are the ones they'll want. And they'll do all property types. So they'll do the office, industrial, retail, apartments, even hotels, self-storage, mobile home parks, fewer of those, but they'll do all the main commercial property types, and they're going to be the lowest interest rates. But along with that, getting the lower interest rates, they'll also be non-recourse, but they're going to be lower loan to value. So they're going to typically max out at somewhere between 65 and 70% loan to purchase price or loan to value. And that's because they underwrite very conservatively. But borrowers love them because they're a little bit more flexible to deal with. You could call them on the phone and they'll answer the call, the servicing department, and they're the best rates, and they're also non-recourse, and they'll do 25 to 30-year amortizations. In fact, there's a couple lenders, couple life insurance companies that'll do 35 and 40-year amortizations as well. So they stretch out the loan payments, which makes your payments lower and the returns higher. So borrowers love that. And again, they're non-recourse. So the individual borrower is not personally on the hook for the repayment of the loan.
Yeah. One other thing about non-recourse that I failed to mention, a lot of times the borrowers don't have to come in with their personal tax returns with non-recourse.
And before we move on, guys, sorry to interrupt. Actually, if you can go back to that screen, guys, this is a great chance to, if you want to take a screenshot of that screen, it outlines instead of, you know, furiously taking notes, which is always a good idea. Feel free to take screenshots of this. And Jerry points out in the chat that if you can re-show, can you guys back up to the bank and credit union screen? And you guys can take a screenshot of that as well. Great way to take notes. So just want to.
High maintenance, Jerry.
I know, geez.
And we'll make this available to you all.
Actually, this is good. That's a good way to mention it too. If you go to our Facebook page, Commercial Loan Launchpad, that is where we will make this available. So request to join the Commercial Loan Launchpad. It is a private group, but all of you on here would assumedly be approved to get into that group. And we have other content in addition to this slideshow that we'll post on there.
Yeah, and I just put that link in the chat for you all to join our private exclusive group. And that group, incidentally, is where we announce trainings like this before to the general public. You get first dibs. These guys are always in there doing, we've done Facebook Lives and live webinars like this. There's exclusive bonuses, so be sure to join that group if you haven't already, and introduce yourselves.
And there are topics that we can dive deeper into: underwriting, debt coverage ratio, how to do math, and that type of stuff. But there's been a lot of demand for this kind of high level who's who and what's what in the commercial world. So that's why we're doing this one. Okay, so I'm hoping you got these screenshots. Let's go on to CMBS. If any of you were around during the Great Financial Crisis in the 2008 to 10 range, you know about CMBS. That's commercial mortgage-backed securities. It was the mortgage-backed securities market, specifically more the residential mortgage-backed securities market, that tanked the market, that went south. If you, what's the Great Short? What's the Big Short? The Big Short. The Big Short. If you watch The Big Short, it goes through this CMBS. But what CMBS essentially is these are lenders that lend you money for commercial real estate. But then they pool a bunch of loans together, usually in $100 million troughs or larger, and then they sell it out to investors in the secondary market, 100 to 500 to $1 billion troughs of loans. And the reason it all went bad in the Great Financial Crisis is that these loans are rated. They're rated by rating agencies, And so usually you have troughs that are A rated, B rated, you know, on down to C rated. And back in the great financial crisis, they used to hide some, you know, low rated residential loans at the bottom of this trough. And those started going bad and completely blew up the whole market. But this market is still there. In fact, we're on CMBS 3.0 is what they call it. And CMBS is a good option for, I'll just go all the way through this here. It's a good option for tougher loans, what we call hairier deals. I don't know why that term is there, but it's what it is. Those are deals like a retail strip center that maybe has a vape shop or a laundromat, dry cleaner that has some environmental issues, and short leases. Because they could do what's called structuring. So they will collect some money up front to pay for any tenant improvements or any lease up costs, anything like that, or any mitigation that needs to happen. And they may collect a little bit more than your monthly payment to cover future mishaps on the property as well. But they will go, because of that, they will go higher loan to value. So they'll go up to 75% loan to value. They'll do all of the property types in commercial. They'll do 3, 5, 7, 10-year loans. Typically, they could do 12 and 15-year loans sometimes. And they're typically 20, 25, or 30-year amortization. And the difference is they're going to be a little bit, because they're tougher deals, they're going to be a little bit higher rates. So they're going to price them off of the 10-year swap or the 10-year treasury as well. And their spread is just going to be a little bit higher. So whereas, I forgot to mention, life company spreads are the lowest. They're going to be somewhere around 1.5 to 2% over the 10-year treasury. CMBS right now is actually 2.75 to almost 4% over the corresponding treasury, depending on how the complexity of the deal. But again, they're non-recourse. It's kind of a set it and forget it type of deal. So once you get into a loan like this, you're kind of in there for the full 10 years, typically with a CMBS loan. And all these non-recourse loans, by the way, are assumable. And you're probably hearing that a lot in your world, in the residential world, because there's a lot of loans out there with 2% rates, 2 to 3% rates. Well, it's the same in this world too. All these non-recourse loans are assumable, so someone could take over that loan if they decide to buy this property in the future. And the last thing are debt funds. So debt funds, it covers a wide array of different types of lenders. It covers your hard money lenders, which nobody loves, but there's a time and a place for hard money. It covers your pension funds and hedge funds. And then it covers your family offices. So, if everyone knows a high or ultra high net worth individual that has, sold a company, has $50, $100 million to spend, they create a debt fund oftentimes, and that debt fund is used for many things, but some of them use them to do loans on commercial properties. And these also do commercial construction, bridge, mezzanine loans, which is like a second, permanent financing, and also equity. So kind of like a down payment for your commercial deal. They're typically larger though. They're typically starting at $15 million minimum loan amounts and go up to, $200 to $300 million loan amounts, which is great. They're also non-recourse, but they are higher rates. So their rates are, I didn't put it on here, but their rates are based off of the SOFR index, which is the Secured Overnight Funding Rate. I think I always forget the acronym, but SOFR, and that right now is 5.3%. And they're usually SOFR plus 300 up to 600-700. So you're talking about an 8 to a 12% interest rate. But there's a lot of benefits to working with them. They don't have like a servicing office behind the scenes that you can access. They are, your loan committee is usually 1 to 5 people. They are the ones that typically fund the loans for you. They service the loans. They're the ones that you talk to. And they're willing to do stuff that's also a little bit more difficult to do, but more higher quality properties as well. And they'll do single loans up to 85% of cost oftentimes. Or if they don't do that, they'll do a loan to 65% loan to value or loan to cost and allow a second lender to come in and do a second loan or some equity funding. I know that's a lot to handle, but that's another resource that's out there. That's actually probably the most common lender right now, especially when banks are having a hard time funding loans because of the depository requirements and their boxes shrinking and a lot of different things. So debt funds are very prevalent right now. There's a ton of capital, billions of dollars of money sitting on the sidelines in debt funds where they're ready to execute loans.
Yeah, and another thing about debt funds, since they are pension and investment groups, they need to send that money out into the world so they can get returns on for their clients, and so they're willing to do like Colton said, hairier deals, and they're fairly quick. Anywhere from 2.5 to 4 weeks execution. So.
Yeah, that's a good point. And even when you get to the debt funds that are higher rates, 12 to 15%, they could close in 1 week to 2 weeks.
Yeah.
And those are the ones where they're not bankable. So, you can't go to a bank or any other lender typically to get a loan, whether it's because of the borrower credit or the deal itself is a lot more complex. Those hard money lenders will give you a higher rate loan because of the risk profile. And a lot of investors are okay with that because they could still make a return after even paying that high of an interest rate. I saw a question on the chat. I'm going to address it now, even though we said we do it at the end, but I saw it on the chat about broker fees. The question was, is it common for brokers to get the broker fee directly from the borrower in the commercial world? The answer is yes. In fact, I'd say 99% of the commercial lenders out there require you to collect your fee directly from the borrower at closing. And all borrowers know that. It's common in this industry. There are only a select few types of lenders that will give you, that will pay a broker either through yield spread or other sources. And those types of lenders are actually SBA lenders and agencies. So your Fannie and Freddie. And then there's a few outside of that here and there, but they're not very common. It's very, very common to collect it directly from the borrower. All right, so on to loan types. We're going to go through construction, bridge, permanent, and SBA.
All right. So construction. So, typically how, you work in the residential world, it's, you go off an LTV. On the construction side, you go off of the LTC. So they'll go up to 75% of loan to cost. And so if a project costs, $2 million, they'll go up to 75% of the total cost. And they look at the stabilized NOI, the debt service coverage ratio, at a 1.25. If you've been to any of our other webinars, we've mentioned and gone through the DSCR in detail and how to calculate DSCR, but they'll go off of the projected debt service coverage ratio once the property is fully occupied and running at 100%.
That's how they determine the loan amount. So you could go up to 75% loan to cost as long as it is above a 1.25 debt coverage ratio on your stabilized NOI. That's your net operating income once the property is fully completed and occupied and making money.
All right. And, construction financing, typically 12 to 36 month term. That's determined by the contractor. And then the rates are mostly floating. So they're adjustable rates. They're typically fixed for, the period of time that they're looking to do the construction financing, and they're interest only payments. They collect an interest reserve. If you've ever done a construction loan, you have the loan amount, then they collect the lender has a calculation of how much interest and, the draws from the contractor. They factor that all in and they'll collect all that up front. So.
Okay, bridge loans. They are for value add business plans on commercial real estate. So what that means is, let's say, in fact, I got this loan request today. I have a client that has a 50-unit apartment complex that they are looking to, that is 100% vacant. So they bought it a while ago. It's old. It has not been rehabbed. It's ugly inside. And so a bridge loan is used to either purchase or refinance that property and give you an allowance for the construction or rehab budget. So if you're buying a property for $10 million, and that's a 50 unit apartment complex, and it needs $2.5 million to get up and running. So basically do maybe new roof, new parking structure, new utilities, but then typically it's updating the cabinets, carpet, flooring, that type of stuff, and put some new lipstick on it. Then what you could do with that is increase rents or bring rents up to where the market is. It's a very common strategy to make money quicker. And there are bridge lenders that are specifically designed for this execution. For the most part, banks do not do this. There are some banks that can do this, but most banks do not do this. It's typically done through debt funds. That's the most common scenario. And then there's some life companies or insurance companies that'll do it as well. And a couple other, but those are the main two. So they will go up to 175% of the cost of the purchase price or of the cost to purchase and rehab. And some of them will even fund up to 100% of the rehab costs. So in that scenario that I just mentioned, they may give you a loan of $7.5 million for that $10 million acquisition, but they'll also give you $2.5 million in a loan as well to do all the rehab, because they are in it to win it as well, as much as your client is. And they want to make sure that the business plan is enacted and is successful.
Yeah, and part of that, the reason they'll give you up to 100%, at the current LTV is because they're looking at the ARV, the property after it's.
And that's all based on this, again, the stabilized NOI at 1.25 debt coverage ratio. That's how they determine how much loan they could give you, even in that scenario. Same types of terms. They could be shorter terms, because sometimes these properties are either 100% occupied or 75% occupied, but they just need more lipstick so that they could raise rents. And so that may only take 6 months, but some of them, like vacant ones, may take up to 36 months, bigger properties. Again, they're interest only payments. If your property itself, the cash flow cannot support those payments, then they will collect an upfront reserve, or they'll finance the reserve. So instead of giving you that $10 million loan, they may give you $10 million or $11 million, and that additional $1 million is to cover interest payments to themselves for the term of that loan. And then sometimes recourse is required, but for the most part, these are non-recourse loans as well. Because there's, assumedly there's a lot of value. So you're going to buy it at a 75% loan to cost, but once it's stabilized and up and running, you'll be at possibly a 50% loan to value. And so the lenders like that execution and know that you'll be able to get a permanent loan after this bridge loan. So most of them are just bridge loans for that short term. Same with the construction. Some of them are bridge to perm or construction to perm, but those are not very common right now, because most of these borrowers don't want to be stuck in today's high interest rates for 10 years. They want to be able to refinance in 2 to 3 years and get a better rate. And then there's permanent loans. And these are what you guys would see as your conventional loans, conventional financing. And permanent loans in the commercial world are not like residential. Your permanent loan or your typical loan is a 30-year fixed loan. Most commercial loans are 5, 7, or 10 years. And the reason being is that typically within 5, 7, or 10 years, these investors have a business plan or a capital event that will change considerably within that 5 to 10 years. So they might have a partner buyout. They might have like a value add type of deal where once they hit, top value, they're going to sell it. They might have, there's death in the family or to partnerships where they might need to liquidate. A bunch of reasons, but most of these properties are have a liquid event or capital event within 5 to 7 years. And so they're 5 to 7 year, 5, 7, or 10-year loans with 20, 25, or 30-year amortizations. That rehab cost was not supposed to be in that one, so that was not supposed to be in there. So disregard that one. So permanent loans. So let's just go back here to permanent loans. So permanent loans, again, are 20, 25, or 30-year amortization, typically 30-year amortization on multifamily properties. All of the lenders that we went through before, your banks, credit unions, agency, debt funds, and life companies, and CMBS, they all do permanent loans. They do permanent financing. And some are going to be recourse, some are going to be non-recourse, depending on your source. As we mentioned before, banks are typically the ones that are recourse, and all the rest are typically non-recourse. There's an option to have interest-only payments for 1 to 10 years, depending on a lot of metrics. And that is the most common loan. And so that's when you have a property that you're going to either buy or refinance that's currently spitting off cash flow, that's pretty predictable, and you set a long-term interest rate so to predict your return on that financing.
Yeah. And just one other thing about permanent financing is when you're working with your clients, and as Colton has been talking, there's a lot of different lenders and loan options for these borrowers. And so, if you just show them a spreadsheet of, the different loan programs with the terms, the interest rates, and let the borrowers, choose which one works best for them. Every borrower, they have different needs, they have different wants, right. An idea of which deals or which loan program is going to work best for them. But if you show them everything up front, and you've done all the shopping for them, they'll stick with you and they'll choose one and close the deal.
That's what we call covering the market. And we usually put together a loan matrix, and it may not come as a surprise to you, but interest rate typically is not the most important thing in the deal. Oftentimes it's recourse or non-recourse. It's the term of the loan. It's the amortization, which may dictate the debt payment, which is directly related to the return for the investor. There's other non-financial terms that are extremely important to some of these borrowers too. And so what you want to do is cover the market, show them a spreadsheet of all the options, and you may be surprised which one they choose. And so what you think may be the best loan oftentimes is not the best loan for the borrower. And so you want to be able to show them all the options. And it gives you a higher probability of closing the loan as well, because they know that you've worked hard for them and covered the market.
Yeah. So I love SBA loans. And so that's what we're talking about now. In my office, we do a lot of SBA loans. And I guess one of the reasons I really like SBA loans is because I like to talk to business owners, and they're either getting into a new business or their business is growing and they need to purchase a warehouse or a restaurant building or a gas station. SBA is a great option for business owners because they can own their own real estate for 10% down. So going over SBA, there's two main SBA loan programs. There's the 7A and the 504. There's a lot of details that go into both of these loan programs, but consider the 7A as deals that are a little bit hairier. They're good businesses. However, maybe the financials aren't looking as strong for one reason or another. Or 7A is a great loan program if the borrower wants to buy the real estate, but then also add in some additional equipment, and they want working capital on top of that. So it's kind of a big bucket that you just throw everything into the deal. The 504, this loan program, it's great for stronger businesses. It'll actually go up to $12-13 million in loan amounts. So higher, bigger deals, and so it's a great option for them. So next, like I mentioned before, they'll go up to 90% loan to value. There is ways to get it up a little bit higher. However, they do have to come in with the 10% equity. There's ways for the seller, if they're purchasing a building and the seller's willing to do a 5% carryback, there's an option there. Or if they have the 10%, then we can add in some working capital to help make up the 5% or so of the loan amount. So recourse is always required. 7A, if the borrower owns their own home, 7A will require them to cross with their home. 504 doesn't. So 504 is a great option for them. They're all permanent loans. They are fixed and floating rates. And so going back to the 7A and 504, the 7A is typically a floating rate. They do have some fixed. They have a promotion right now on a 3-year fixed. And then on the 504, it's actually 2 separate loans. You have the bank financing, and then you have the CDC 504. And the 504 with the 2 loans, the bank is typically fixed for 5, 7, or 10 years. And then the floating or the SBA's debenture, that one's fixed for 25 years. And so your blended rate is, right now it's in the 8s, mid 8s. So it's not a bad option for borrowers if they only have to come in with 10% down. So, and the amortization, that's 20 to 25 years. There again, the reason it could be lower than 25 years is if the borrower prefers a lower amortization, they want to get it paid off quicker. So, yeah.
So that's the main portion of our content. Dave, I don't know if you want to do Q&A after this, but appreciate your time. It's been great, and we could go into detail through this next step with each of you individual if you prefer. So I know a lot of you have questions, which we'll get to your question Q&As, but we also have an option for you to get more answers to your questions, whether it's related or unrelated to this specific webinar. So we have, which Dave mentioned at the beginning, a $497 bonus, which is your opportunity to be able to speak with one of us for a half-an-hour call, in which what we call a 7-figure fast track session. So if you go to www. and you have to type in www.commercialloantraining.com/fast track, it'll come up with a calendar where you could schedule a call with one of us, and it looks like this. So again, www.commercialloantraining.com/fast track. If you go to there, you could schedule a call directly with one of us, and we'll talk to you about your specific questions, but we'd also like to go over if you're interested in kind of a strategy and game plan for you if you're interested in getting into commercial lending. And so if you want to schedule a meeting with us directly, again, www.commercialloantraining.com/fast track.
And I also dropped that link in the chat for.
Okay. Link in the chat as well. You can copy and paste from Dave, and would love to have a chance. I noticed Todd, I noticed Emily, I noticed a bunch of you on this call today that have already scheduled a call. So we look forward to speaking with you individuals, and truly, honestly, we love teaching. We found this opportunity, 10 years ago or so. We started teaching MLOs one-off because they came to us with deals, and we started needing to educate them on this process, on how to do commercial loans. And we found out that there's no formal training at all for commercial lending. And so we've decided to do that ourselves. And so this is a passion project of ours, but we are deal guys. We do deals every day, all day. And that's what we love doing. We'll go to Q&A. I know there's another question on the chat for Q&A. And I think one of the questions was, are agency loans available for owner-occupied gas stations? The answer is no. Agency loans, which are Fannie and Freddie, they are only for apartment complexes and then limited mobile home parks and seniors housing. So that's all that the owner-occupied loans are for. For the agency loans are for. But if you need a gas station loan, as Derek would tell you, one of the best options, if not the best option, is actually an SBA loan. And a bonus for the SBA loan, the 7A and some 504 lenders do pay brokers on the back end. So you could actually make a point on the front oftentimes plus 1 or 2 on the back, which is phenomenal.
Yeah. All right.
I was taking track of the questions as they came up in the chat, guys. So I'm just going to run through those in the order that they came. Daybreak Mortgage, whoever that is, said, what is the average broker fee? And then Christy followed up with a secondary question related to that. Is there a standard broker fee that gets charged?
Yeah. So the average I would say is 1%. However, it's open. You can charge depending on the type of loan program. You can charge 1% on the front end and get a half a point or a point on the back end, depending on the loan program. But I would say the average is 1%, and you can make up to 2 or 3 depending on the loan program. Like on the debt funds, 2 points is very common. On SBA, 1 to 2 points is very common. So
it just depends on the difficulty and size of the deal. So if it's a highly competitive deal, so a permanent loan that's a Class A brand new apartment complex that's stabilized, that's going to be highly competitive, and so you're going to get 1 point or less. But if you're looking at a lot of tougher deals, you could get more. And honestly, if you're a greedy broker, which some of you are, I'm sure, but if you're a greedy broker, you could get as much as the borrower will give you. So if you show a huge value to your borrower and they see value in paying you more than 1%, then that's your prerogative. But I would recommend, however you do it, you get a fee agreement signed, which I think we do have. If not, we will have one in the Facebook group as well. So again, that Facebook group is Commercial Loan Launchpad. So if you haven't gone to that, go ahead. Okay, next, Dave.
All right. Sejal, sorry if I'm mispronouncing that. Sejal says, do commercial lenders work with borrowers directly, or do they prefer brokers? He has a client base that would go directly to the lender if possible and save on paying the broker fee.
So that's a very good question. So the answer is yes and no. So there are some lenders that will only work with brokers. And for the reason we mentioned in the leads at the very beginning is that they find that they get more deals and higher quality deals directly from brokers. And they don't want to field millions of calls from borrowers with deals that are just aren't good. And so they see the brokers and the value of the brokers and being able to screen those deals. And so a lot of those lenders actually are debt funds and life companies. Those are the ones that primarily want to work with brokers. But as you can imagine, banks, especially your local regional banks, they do go after borrowers directly. And so your biggest competitor typically is not another broker in your local market. It'll be other banks in your market. And so, and like Derek mentioned earlier, every bank has their small little box that they operate in, and nine deals out of 10 don't fit into that bank's box. And some other tips that I'll give you too, if you're a good broker and you look at the numbers and underwrite it well, oftentimes you'll even get a better deal at the borrower's bank than they will at their own bank. And so that's a way to talk to your borrower and provide value there as well, to negotiate with their specific bank, because you can save them money by going to their own bank sometimes.
Yeah. And then another thing, working with borrowers, and let's say that you do take them to the bank, and just let them know that the bank's box is always changing. And so when you've shown the borrower a number of different loan program options and funding sources, and going back to the leads and finding clients, you're going to have a database of borrowers, and you just keep them up to date via email, of different loan programs and rates and terms that are available, and let them know that it's not the best option for them just to go to their local bank, because their local bank, especially here in Utah, the closest bank to me, they charge the highest rates, and
right.
And so they think borrowers go in there and they think, oh, I'm getting my deal done, but really what they're doing is they're getting a high interest rate and they're just being taken advantage of.
One more key tip on banks too, by the way. If I were you and you were looking specifically to get commercial loans, I would hang up the phone or the Zoom call right after we're done and directly go to banks and call those business bankers. Here's the reason. Most clients have 1 or 2 banking relationships. Most investors have 1 or 2, sometimes 3 banking relationships in your local market. Most of those banks have either stopped lending altogether right now in commercial lending, or their requirements got extremely difficult. Like they may require 20 to 40% of the loan amount in deposits with the bank in order to do a loan. So most of these borrowers are looking for brokers to find other sources for loans, which what we said before is there's a ton of capital out there. There's a ton of lenders, ton of options for these borrowers, but they were so used to the heyday with being able to call their local banker and get a loan, from a phone call basically, and now they can't. So they are desperate to find brokers to be able to source other loan options for them. So that is, I don't know if you guys realize how big of a key that was that we gave you at the very beginning. Call the business bankers right now.
Yeah. All right, Dave.
All right, fantastic. That was great feedback. Fantastic answer. We are nearing the top of the hour, so I just want to be conscious of everyone's time. We're getting some fantastic questions. We got about 6 or 8 more to go through, so I'm just letting you guys know that we may go a little over, if that's okay with you guys. If you have to leave, we completely understand. Before you do, make sure you grab your $497 bonus at Commercial Loan Training, www.commercialloantraining.com/fast track. I put that link in the chat for everyone. So we're going to continue on these questions. If you can keep on staying on with us, we're going to stay as long as we need to make sure all your questions are answered. And then we'll get your custom questions answered on your one-on-one call when you join us at www.commercialloantraining.com/fast track. Okay, so this is one about permanent loans. Dave asks, in the commercial world for a construction or rehab, is it normal for a borrower to be underwritten for the bridge and the final permanent loan at about the same time?
Yeah, good question. And we kind of glossed over that fairly quickly. And we did answer that, but maybe not as directly. So the way that they size a construction or a bridge loan is by basically determining or sizing a permanent loan at the end of the construction loan. So they're basically looking forward and saying, okay, if this construction loan was done in 3 years, are they going to be able to get a permanent loan? And so that's why they underwrite to what's called an untrended stabilized NOI. Untrended means if you were building the property or rehabbing the property, and even though it may take 2 or 3 years to do it, they assume that it is done today. So if it's magically done immediately today, they look at rents today, at what it would rent at today, and then calculate your net operating income and the debt coverage ratio based on that, and then back into a loan amount based on that. But that also solves for what type of permanent loan would be able to get done in the market upon completion. So it's sized, but we're not doing a term sheet or a letter of interest or anything like that at the beginning. Typically, we are just doing the math to make sure that it pencils for a permanent loan.
Mm-hmm. Yeah, and one thing that I like to do is, sure, the borrower has that option is, they do the construction, but then they have a long-term permanent option that's built into that loan where the project will eventually convert into permanent financing if the borrower wants. However, I always like to come back around towards the end of the construction period and give that borrower other loan program options that may or may not be better, but at least they'll have additional options. So, yeah.
Fantastic. And related to that, Jerry was asking if you can go back to the permanent loan screen so we can take a screenshot of that, if we can get that up and running.
And is that Jerry again?
Jerry again. Hi, man, it's Jerry. No, I'm just teasing you.
Jerry, by the way, so no, we cannot, because this was all the wrong information. So we will update that slide. We will update that slide and actually send it to the Facebook group. And so you could download it and it'll be correct at that point. But we actually accidentally transferred the bridge criteria into the permanent loan section. So do not, if any of you did copy that, disregard that. We will have the updated slides in the Facebook group.
Okay, fantastic. Thanks for that clarification. Johnny asks, are there agency lenders that will finance an OO convenience store?
We already answered that. The answer is no.
Okay, very good. Sorry if I missed that, my bad. And then Zhiling, hopefully I got that right pronunciation. What about a startup loan? How to do it? For example, you rent a big place and do a big sushi restaurant. Can you get a loan on that? Do we need a good business plan? Who will do this type of loan? Debt funds, lots of baked in there. Jiling, if I'm pronouncing that correctly, if you're still on, feel free to unmute yourself and explain a little more about what you're looking for, because there's a whole bunch of questions in that one rolled into one. If you're still here. If not, if you can answer that as best you can based on that information, guys.
Yeah, and I can take that. So, so for a sushi restaurant specifically, yes, the best option for that is going to be an SBA 7A loan. And they'll do a startup. They'll go off of 2-year projections that the borrower put together for the, the gross income and the projected expenses on the business. And then they'll go off of that. So if they're currently running a sushi restaurant and they're looking to either purchase their existing location where they're operating out of, or if they're, they find another location down the street, or if they want to open up additional, expanding their restaurant chain. SBA is also another great option for them. They only have to come in with 10% of the total project cost. So the total project cost could be the purchase of the building, plus all the kitchen equipment and the sushi bar and the chairs. And then also they may need some working capital for payroll, marketing.
SBA is built for that. They love startup. They love business owners. They love startup business owners. So that is what they are. They are meant for. They are more friendly that way. There are conventional options, but they're not as good or beneficial to the owner.
Yeah, and I would direct them specifically to SBA for restaurants, car washes, gas stations, especially on the startup, just because those are considered specialty type properties. They're higher risk. They're not as sought after by traditional lenders. And so if like for example, if it's an engineering firm and they're looking to open up their own office, traditional conventional banking or credit unions would be a great option for them besides SBA. But for a restaurant, gas station, car wash, I'd go with SBA. So.
Fantastic. Thanks for that, guys. I have to chuckle because we have a whole bunch of what I'm calling K questions coming up. We have questions incoming from Keith, from Ken, from Kim, from Christy, from Keith again, from Ken again. They're all Keith, and one errant one from Dave. And I'm a Dave too, so I can relate. So
many Ks are better than 3 Ks, that's for sure.
Yeah, we got like quadruple Ks coming in. All right, this one's from Keith. Does a commercial borrower need to have a previous experience at all?
Great question. Yes and no. It really depends on the type of loan, the type of lender. So yes, we would prefer, the lenders would prefer previous experience, but you have to start somewhere.
Yeah. And
there's going to be lenders for that. So it may be a lender that may be a little bit higher interest rate, like a bank or a credit union or a debt fund for your first deal, but it doesn't have to be. So if that borrower is a high net worth individual and they have really good cash flow from another business and financial sector or tech industry or some other industry, a bank could underwrite, it'll be a recourse loan, but they could underwrite that cash flow and qualify someone based on their personal qualifications. Keep in mind that most commercial loans are actually opposite of how residential lenders underwrite. Residential underwriters typically look at the borrower first. They look at their credit, they look at their cash flow, their debt to income ratio. Most commercial lenders are opposite. They look at the property cash flow first. That is the most important thing, because that is their first source of repayment, is actually the property cash flow. And then their secondary source of repayment is typically the borrower. So if one of those two things are really strong and the other is weaker, then they'll rely on one or the other. And in this case, if it's a brand new borrower to commercial real estate investing, I would say go to a bank. A bank will underwrite the borrower specifically and their cash flow and their credit, and they'll get them qualified that way. But if it's a apartment complex, for example, Fannie Mae or Freddie Mac may, not always, but may be able to do a loan for them if it's a great deal, great property, but they may require like the borrower to have third-party management. So they can't manage the property themselves. They don't trust a new investor owner managing the property themselves. They want to have third-party management company in there, and other people on your team that may be invested or have experience in that part of the industry would help.
Yeah, and if we're talking about like SBA financing, and they're looking to purchase a business that they don't have previous experience, They may require a manager to remain on as an employee.
Hotel management is very common that way.
Yeah.
If someone buys a hotel for the first time, they'll just keep the current management on site at the hotel because it's predictable on how that manager manages that property.
Yeah.
Next,
Fantastic.
love it.
Cool.
Thank you for
All
sticking
right,
around.
on-
I know we still have 53 of you on there. We'll stick around a bit longer if you want to. And again, if you need to jump off, we totally get it. We promise an hour and we're there. But we're here to answer questions for a little bit longer for those that want it.
Absolutely. Next question, incoming from Ken. He has a church that wants to refinance their loan. Can y'all do that?
Yeah.
It's amazing how much churches make these days, huh?
There's a lot of churches.
It's crazy.
Yeah. So churches, yeah, I've done a number of churches. I currently have a few churches in my pipeline right now that we're funding, and
Yep.
And so to give you an idea how churches typically work is most churches that we've dealt with, they don't file taxes, and so we'll have to have audited financials, and just in a nutshell, I'll give you some basic guidelines for that. They have to have 200 members or attendees, congregation attendance weekly, and that can include a weekly Bible study and Sunday service, and then loan amounts are they're limited, not necessarily on how much they can afford, but it's how much tithing or donations that they gross annually. So it's usually 3 to 4 times their annual gross collections for the year. And so let's say they collect $1 million a year, then their max loan amount would be $3 to $4 million. And so that's typically how they work. They're fairly basic.
I didn't know that.
Yeah,
I didn't even know that.
and so one thing about loans for that, minimum loan amount, is $500,000. So we've come across a few different churches that we have to turn them down just because they're looking for 250, 300,000. We typically don't do any loans under $1 million, and so.
And I'd recommend you guys too, those that are doing commercial loans, I would recommend you limit your loan size to $1 million minimum.
Mm-hmm.
Because you'll find that $1 million loan is the same amount of work as a $50 million loan. And, I would rather you fill your pipeline with that, larger size deals, but more importantly, the cost to the borrower to have a broker involved in a small loan under $1 million is actually oftentimes prohibitive. And you'll find that you're spinning your wheels and wasting time. And then there's a lot of lenders that won't go below $1 million either. So
yeah,
your highest probability is $1 million and above.
Mm-hmm.
And to that point, you raise a good point. What would you say is the average loan type? Or not type, amount, sorry.
Yeah, average loan size nationwide is about $5 million. And so as we were talking about broker fees before, that means your average fee is about $50,000. And so that's what you want to strive for. And that includes, there's a lot of $1 million loans, but there's also a lot of 10, 15, $20 million loans out there. So it averages out to about $5 million per loan. So that's a pretty hefty, I would say, increase, because I think your average, depending on your market, right? But your average residential loan is a tenth of that. It's about 500,000. And so, you could do, again, the same amount of work on a commercial deal and 10 times your income.
Absolutely. And I just want to remind everyone, we can customize a game plan to get you into the commercial loan game to get those average commissions of 50 grand a pop. That's why it's super sexy, super lucrative. Once again, I dropped that link in the chat for you guys at commercialloantraining.com/fast track. We can get that all sorted out for you. In the meantime, we have another question about accessing agency loans. How would you access those?
Well, it so happens that I work for a company called Walker & Dunlop, and we are the largest agency lender in the country. So I actually am one of 20 different agency lenders in the country, direct. So I am your lender for that. I do Fannie, Freddie, and HUD loans, which we didn't discuss today. And so that is probably your best way. You could reach out to us through the meeting invite there on commercialloantraining.com fast track. or reach out to us in responding to the email that you had to invite you to this webinar. So that is the best way. But there are, I think there's 26 total agency lenders out there. They all specialize in different types or sizes. There are 4 licenses within the agency world. There's small balance Fannie, small balance Freddie, conventional Fannie, conventional Freddie, and not all of them have all 4 of those licenses. And the difference between small balance and conventional is $7.5 million. $7.5 million and above is conventional as far as loan amount, and below is small balance. And so reach out to us first, and we'll be able to help you with that.
Yeah, and I put in there's a few latecomers and stragglers coming in. So I also put the link into our exclusive Facebook group where we interact with you guys. You can ask further questions there, access Colton's and Derek's brain as well, or just get on a one-on-one call for much more personalized access.
Yeah, you guys throw that's a great point. Throw out on the Facebook page. You can throw out questions like this as well, and we'll get to them and answer them. We want to create the whole point of the Facebook group is to be able to create a community where we are educating each other in the commercial finance world. So some of you actually have a lot of industry experience and may have local community knowledge in your local markets that we may not have, or someone else may need. And so we want to foster that community in commercial finance. And so if you have questions for us or the rest of the group, please throw them out there, join the Facebook group.
Yeah.
And I did notice a ton of you did join just during this call when I dropped that link in there. So that's awesome. Welcome to the tribe. Some of you actually won't get approved because you didn't agree to the group rules. So if you want to join me,
no, don't do that, guys.
All right, and they're common standard group rules, like no spam, play nice, no profanity, be respectful, all that stuff. So agree to the group rules, answer the group questions, and you're in. So we can play nice that way. But we are building a tribe and community around this to answer your questions and to be honest, inspire each other, share your success stories, right? And all learn from each other, because as I mentioned before, rising tide lifts all ships. We want to help rise that tide. Okay, moving on. Dave, finally not a K person, we got a D person. Dave asks, on an SBA loan, is YSP paid on both the first and second debenture loan? And if not, can the second include some type of compensation for the broker?
Dave, you sound like you know the answer to this question, but I'll let Derek.
Yeah. So SBA, they have some funny guidelines. So with SBA, I'll talk about 7A first, and then I'll switch over to the 504. But on 7A, how they typically work is you can collect on the front end or you can collect on the back end, but you can't collect on both. And so if you collect on the front end, SBA, they want you to fill out what I call like a time card, showing how much time you spent on the deal and justifying your loan fee. And so that's, I don't know about you, but I don't have time to keep track of every 10-minute or 20-minute email that I type or phone call that I make, or, time I put into processing, or my team. And so we just collect on the back end. And so on 7A, it's anywhere from 1 to 2% on the back end for a 7A loan. Going to 504, 504 there again, it depends on who the lender is. And so we've had some lenders that they'll pay on the back end, and we have some that they pay on the front end. There's some lenders out there, I don't typically work with them, that will only pay on the first and not the debenture. And so I typically will go after the lenders that will pay on the full loan amount, both the first and the second.
On 504s, what typically happens to me is I charge an origination 1% on the full loan amount on a 504 on the first and the second, and then get yield spread or YSP on just the first on the back end, which ends up being more than about 1.5% of the loan amount total. Yeah. Okay. It just depends on the lender on the 504 for sure. There's different lender requirements and such.
Excellent. Okay, we're plowing through these questions. We've got a few more left. Upcoming from, we got Ken, Christy, Keith, Ken again, Emily, Elizabeth, Marion. So I've been listening to you all. We'll get you all handled. First from different Ken this time. Ken, Weinstein or Weinstein. Apologies if I miscorrect that. This one's a little complicated, so I'll review the question first, but then Ken, feel free to unmute yourself if you want to extrapolate a little more, because Ken asks, what's typical for an apartment complex when they want to expand into a new building, but have current loan for renovation of the current buildings? The new building might also have commercial space on the first floor. So how does one navigate amongst all these lender types? For example, residential has loan sifter and so forth. So to compare via the rate.
Yeah, so, and again, Ken, if you want to unmute yourself and clarify, please do, but I think I understand the question. So there's a lot of different scenarios here. When you have an apartment complex sitting on a piece of land and you have room to expand and build another building or expand onto that building, there's a few different options depending on the structure. So if the current building is fully operational and everything's good, and you could build an addition to or a second building without disrupting the tenants on the first building, then you could either do a bridge loan that collateralizes. It's essentially a bridge loan, but it's a construction loan. It's kind of a mixture between the two. So let's call it a construction loan. So you do a construction loan essentially for that new building or that new add-on, and they will collateralize the first building, which may reduce your down payment requirement, but also covers your monthly payment for that construction loan. So your construction cost gets reduced by the amount of that interest reserve, because that interest payment should be coming from cash flow from the existing building. Now, if it's a building that is not cash flowing or fully operational and either has zero income or partial income, then it's the same scenario where you have one loan over the entire two building plus your add-on. And then they would have to collect an interest reserve to cover payments for both. The cleanest way, however, is to subdivide or parcel off the addition if you can. So if there's a second building that is not attached to the first building, then you go to the city and parcel off that first, and then you could do a completely separate construction loan for the addition. And then you could cross-collateralize easements so that, it shows that you have access to the amenities for the first building or first phase or whatever it might be. And you could still cross-collateralize the first piece. But the benefit in parceling off the addition is that you could refinance or sell the first phase separate of the second phase if you want to. And so they're not tied together if you don't want it to be. So it gets pretty messy. Is that if you want to unmute Ken, does that answer your question, or throw it on chat if it does?
Yeah, he's saying, oh, are you there now, Ken?
Okay, can you hear me?
Yep.
Okay, yeah, your system wouldn't let me unmute, so I just sent a text thing on that. All right, so yeah, basically it's multiple buildings. It's been an apartment complex that's been around for quite some time, probably when I was a kid, and I don't want to tell you how old I am, but
you look no older than 38.
Of course. So, but anyway, bottom line is they're trying to build this new one, and I just didn't know, if I try, I've called one or two lenders to start off with, and I kind of got refocused on some other things, but I want to attack this thing. I just don't know, which set of lenders might be the best, or what type of loan would be the best, and how would I compare against, say, a bank or whatever, because they did get a loan to refurbish all of the other units. I don't know how many buildings it is to include also, well, I don't know if they added a pool or something, I don't know. But anyway, bottom line is that was done, probably when rates were quite a bit lower. So probably don't want to touch that. I just didn't know how all this fits into LTC or any of that kind of stuff, and how I can competitively go in and have them want me to do this.
First, I would suggest you schedule a call with us, and we could go over that specific property, the deal in detail with you if you want, Ken.
Okay.
Because there's a ton of moving parts, and so in general, I think we answered the question. But I think in order to get you a real good answer, I think we need to go through the detail in more detail. And I think you're right. If they got a loan before, mind you, if they got a rehab loan before, like a bridge loan, it's probably a floating rate loan. So they probably priced it off of SOFR, or at the time it was a swap. And those rates have been going up every time Feds raise their rates. So their loan actually interest rate may be very high on that, even though they closed it a long time ago, because they're typically floating rate loans. Not always. They could potentially have a fixed rate loan on there. So that's one thing to figure out. And then based on everything that they've done there, that would answer what we need to do for the other buildings, and how to tackle that. So
Yeah.
be happy to jump on the phone with you specifically on that and kind of strategize with you.
Yeah.
I will do that, and I appreciate it. But just real quick, just in general, for something like that, if they're a company that's been around quite a while and all that kind of stuff, would a broker in my position have a hard time trying, if they focus on the rate aspect of this, pricing aspect of it, would I have a hard time beating, wherever they may go personally, like maybe a bank or whatever, or
Maybe not. Honestly, like I said, their personal banking relationships may not be lending on that type of thing right now. It's a very small market for bridge and construction loans. There are fewer lenders out there right now, and so they may not know who to go to. And so this may be a good opportunity for you to come in and provide a lot of value, a ton of value.
Okay, appreciate it. Thanks so much.
And that's the thing.
And that rate, go ahead, Derek.
Oh, so I mean, if you know what options that they have in hand, you can go and shop it and see if you can beat it. More than likely you can. So.
And we'll tell you, if you could get that information, we'll tell you right off, when you schedule a call with us, whether or not that's a good deal. We know right off the top of our heads if it's a good deal or not, and if it's beatable.
Okay, they haven't told me yet. Thankfully, this is from our cousin who owns.
Oh, nice.
Several cousins who own half of it. The other half, I don't know, but someone on the other half is who's sort of the lead dog. So I don't have that answer. I'll have to search it out.
Okay. Yep.
Thanks so much.
Thanks, guys.
Cool. Derek, can you just go back to the fast track slide for a second, please? Because this is a perfect example of why you want to schedule your one-on-one sessions, guys. Because there's a lot of value baked into there. I don't want to understate it. We are saying it's like basically a $500 value. Can you, and this is a perfect example of look at all the intricacies and details of just one deal that Ken had. And I'm sure all of you have similar scenarios or questions around that to your specific question. So I want to draw attention to that. And Derek Colton, can you justify why that is a $500 value? What makes it so valuable?
Well, I mean, it comes down to, how much money you can make from a specific deal. I mean, if the average deal size is, 5 million, but let's say you have a smaller deal of 2 million, then you can make, point off of that, you can make, $20,000 just by being steered in the right direction.
Yeah, like Ken's deal, I don't know what size we're talking about, but if he gets that deal done, even if it's $1 million, and he gets the deal done because we point him in the right direction, then he's making $10,000 off of that. So that I think the $497 value is kind of very low, but it is what it is. I mean, I think it's much more valuable than that. But everyone's perception of that value is different. But just we're not charging you for it. Let's just put it that way.
Yeah. Yeah. So okay, fantastic. On to Christy. Have you ever run Facebook ads to get leads at all?
I have in the past when I was doing equipment financing and MCA loans, but not on commercial real estate.
You'll find that commercial real estate investors, there's not a lot of them on Facebook. And so your traditional marketing that you would do maybe in the residential world, you probably won't get much traction there, honestly. It's funny because you could buy leads lists and you could do a lot of advertising on social media and just Google ads and that kind of stuff for residential. That none of that works in commercial. And so that's why and I know our list at the beginning on leads to some of you may have been rudimentary and elementary, but honestly, those are extremely effective and probably more effective than any advertising you could do as far as ad spend or anything like that. Mm-hmm. So I would honestly lay off. Don't think about spending on stuff like that for commercial leads, because they just don't. Commercial investors don't go online and Google where can I find a commercial lender. They typically have or know who to start with at some point. And it's usually because people like you are calling them on a regular basis and they're going to remember, oh, Ken called me last week. I need to reach out to him.
Yeah.
And just to build on that, it's all about relationships and the partnerships that you make with these lenders. That's why when they went through the lead section, it's all about the relationships, and that's going to be your biggest bang for your buck, is taking that effort to follow up on what Colton and Derek said in that section, because it's hyper targeted. If you think about it, I mean, they already know what you're calling for if you're dealing with them on a regular basis.
One of the best things you can do on Facebook or LinkedIn or Instagram is just to post, what you offer, so, here's
Value.
Yeah, just, you can post value, or you can just say, hey, if you know of anyone, or if you're in the market for, a commercial loan, give me a call. Love to talk to you.
My LinkedIn page is almost, my connections are almost 100% commercial related, so that when I post something, it's reaching a very targeted market. And so, and it's either posting your, what you can offer, and posting value. So if you're posting, updates on what's happening in the commercial world, they'll start taking notice and start giving you a call that way. So that's good point on social media. Probably the best thing you could do there.
Yeah.
Which is free.
Fantastic. And then Ken just answered your question about his apartment complex. It's about 22 million. So imagine if you were to get a point or two extra off of that, what that would do for your bank account. So
that's a pretty penny. Good job, Ken. That's great. We'll help you with that.
Okay, I see Keith is still on the call, and Keith asks approximately how many commercial lenders do you have in your sphere or access to?
All of them. all of them that make a difference. I'm sure there's some, small, like individual that has $10 million in his back pocket that he'll lend, but basically every single commercial lender that is active in the market, we have access to. And so it's hundreds. It's hundreds, probably not thousands. It's 600-700 probably is my best guess. And we have to keep up on them on a regular basis, because like Derek said earlier, they change on a daily basis. So it's not like, we have access to 20 lenders and someone else has access to another 20-30 lenders. I know that somehow some of that exists in the residential world. We have access to all of them. Yeah.
Like, for example, like SBA lenders, that, there's hundreds of SBA lenders out there. But what it comes down to it is, which lenders are actually going to close the deal and pay you a good.
And there's probably hundreds that are the exact same terms.
Yeah.
And so you only need a select few that have those types of terms, and we'll do those types of deals in the SBA world.
Mm-hmm.
Same with like agency, everyone is, fairly close to each other as far as what they can do. There's some small differences. Life companies and debt funds, they're all really different. Banks are typically within a close proximity as far as terms with each other. But all of them, that's the answer.
Yeah.
All of them that matter.
All of them that matter. All right. Follow-up question from Ken. From a rate and pricing perspective, should we be able to beat any retail side of a particular lender?
Yes. I mean, not every single deal, but our MO, the way we work on deals, is that we are typically the low price leader. So we can match or beat anyone. Mm-hmm. And that's because, from Keith's question, that's because we have all the relationships with all the pertinent lenders. And so we know who's the best in every market and nationally.
Yeah. And they typically will give us par pricing, and, like if they go direct to them or they use us, they're still going to be paying, a point for origination.
Think of it this way. Derek and I combined do about $500 million a year in commercial financing. And I'm not saying that to brag. I'm just saying that because any given lender in the entire country will get more business from Derek and Colton than they would directly from any borrower. And there's more Derek's and Coltons out there that do same or more business than we do. And so that's the same concept with them as well. But because of that dynamic, those lenders are calling us. They want us to bring them business. And because of that, we leverage our experience and our platform and our volume to be able to get better deals than most borrowers can, and a lot of brokers can, going directly to those same lenders.
Mm-hmm.
Absolutely, which is another great reason why you want to join our Facebook group. Once again, I dropped that link in the chat so we can build your relationships with Colton and Derek, because they have access to all these guys. So another good reason for that. Okay. Just want to, Dwayne had to jump off and said, got to go. Thanks for taking time to do this. You're absolutely welcome. We realize we're a little over time. We're trying to accomplish everyone's questions. We're almost done. So thanks for your patience, guys. Emily, finally not a K person. Emily asks, I see you're still on the call, Emily, so feel free to unmute yourself.
Is that Emily with two E's, by the way, at the end?
It is.
Okay, Emily, I've noticed your name. I've noticed you out there. Thanks for scheduling appointments. Glad you're on here still.
Absolutely. So she says, as a broker, she'd love to get approved to work directly with SBA and other commercial lenders, or do I need to be employed by a commercial lender? Residential loans report to NMLS. Do we report commercial lending to an oversight entity?
Yeah, great question. We should have addressed that earlier. The answer is it's a wild west world in the commercial real estate world. You do 99% of the lenders out there you do not have to register with. You do not have, there's no process to register as a broker with most of them. Any of them that you do usually have to register with are actually kind of higher rate lenders that specifically target marketing to residential loan originators like yourselves. And so that's why you see some of that in that world, but those lenders are typically higher rates than your average. So you're not going to have a lot of success with those. So the answer is no, you don't have to register with almost any commercial lender out there. And as far as reporting requirements like the NMLS, no, there are. I take that back. There may be some states in the United States where you do have to report your lending activity, but there's only, I'd say, 5 or 6 of them in the entire country. As to who they are, I think you'd have to do that research yourself, honestly. We don't keep track of that because we, like I said, we could do loans across the country without even a license, honestly, from where we stand and because of our brokerages. And so there's no, we don't have ourselves any reporting requirements.
Fantastic. Elizabeth asks, are there any suggested books to learn more? And I assume complimentary to that question, any resources in general, guys?
Well, that's why we're doing what we're doing. There are very few resources out there. I think if you go to Amazon and look up commercial lending or commercial finance, you'll find a couple books out there. And a lot of them are very rudimentary. I think the ones that are more detailed are your thick, like textbooks that they use in universities, and they'll put you to sleep. But you might find some podcasts and some books and some stuff if you go again to, and I hate to keep on, this is not the purpose of this webinar, but if you go to our Facebook group, we do have a couple things posted up there that you'll learn from. Derek put together a book himself as a kind of a fast start guide to a lot of things commercial related. And then just kind of honestly just search. I don't know of anything specific to you.
No, it's difficult to find, up-to-date material just because, the market's changing so fast. So, yeah.
Well, and to that point, I mean, I just put in the chat as well an image of the book that Derek wrote. So it's called The Ultimate Commercial Lending Playbook. We literally wrote, or Derek at least did, with Colton's advisory position, the book on commercial lending, which is, I'll reiterate, available. We have a ton of resources in the Facebook group. So check out that link. You can grab that book right from our Facebook group when you join. So just make sure you join the group and we'll get you all set up. Okay, a couple more. Marion asked, do you have a YouTube? We actually do, but we're not that active on it, and that's our bad. We're much more active in the Facebook group, and we post recordings to trainings like this there. So once again, be sure to join that.
Dave is, just so you know, Dave is pushing us to do more of that. We're deal guys. We do deals. Yeah. And so Dave's like, do YouTube, do stuff like that. And we're like, hey, we love to, but we got to get this deal done first.
Trying to make the cash register ring.
That's right.
Okay, and then last question from Ken again. State licensing requirements for commercial lending. Are there any?
Yeah, again, so anyone, every state in the country, your residential license does cover commercial as well, which is actually, I think, a major hole in the real estate licensing world. Because commercial does not talk about or need truth in lending and all that kind of stuff, the disclosures that your average consumer needs. but your whatever your state requires covers commercial lending. And like I just said earlier, most states do not even require a license to do only commercial. And you'll have to research your specific state and surrounding states as to whether or not they will require that. But I know it's like Arizona, Idaho,
California.
Nevada, California, New Jersey, and maybe Michigan. And I may be wrong with those, but those are kind of the ones that I know have some regulation around doing commercial loans. And so for sure, I know Nevada, don't do a loan in Nevada unless you have a license in Nevada and have a physical building or physical location in Nevada. And there's some other states like that. I just can't remember which is which.
Fantastic. What about Texas? Ken says, and this will be our last question because we're
Yeah,
on
Texas, you can.
Yeah, the red states, for the most part, as you can imagine, are fairly open for business and are a little bit more lenient on licensing requirements. So.
All right. We're going to wrap there, guys. And we're going on 2 hours. So Fandel's a full almost hour of questions. So that is fantastic.
Great.
We're so glad to serve. And once again, I'll drop in the chat to grab your one-on-one strategy call to build a game plan with Colton or Derek, and we can handle your questions all one-on-one. So thanks so much for everything, guys. We'll see you in the Facebook group. We'll have a recording of this up in there shortly, probably tomorrow, with a whole bunch of other trainings. Derek, Colton, any parting words?
If you have any questions or deal scenarios, feel free to schedule a time so we can talk.
Don't be afraid to get out there and say that you do commercial loans. You'll figure it out if that's what you're interested in. And we're here to help. So thank you very much for your time. I appreciate it.
Thanks everyone.
Take care, everyone. Thanks for joining.